Hey guys, it is Julie here with TipRanks, and today we're taking a look at 4 dividend stocks to help protect your portfolio. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we are discussing dividend stocks. These can be a great way to help defend your portfolio. That dividend income can offer some great downside protection. Plus today we're looking at stocks with relatively low betas. Now the beta is a measure of volatility compared to the market. So with a beta below 1, the stocks are considered less volatile compared to the overall market. We're going to take a look at these companies, what it is that they do, what kind of dividend they're paying, and of course what Wall Street analysts are predicting for their stock's future. You can find other great dividend stocks over on the TipRanks website or by downloading the TipRanks mobile app, which will have links in the description down below so you can check that out. Now let's get right into these dividend stocks. First up today, we're taking a look at Union Pacific. Their stock trades under the ticker UNP, currently priced at $212 per share. They've seen overall growth of 13% in this past year and have cooled off a couple percent in the last few months. They come in with a beta of 0.77 and score an 8 out of 10 on the TipRanks Smart Score. Founded back in 1862, Union Pacific is an American transportation and railroad company. They primarily operate in the western two-thirds of the country, providing essential freight and transportation services across a diverse range of industries. They play a pivotal role in the transportation of goods, including agricultural products, energy resources, industrial commodities, and consumer goods. Union Pacific pays out their dividend on a quarterly basis. Currently sitting at $1.30 per share, that gives them a dividend yield of about 2.5% and a healthy payout ratio at 38%. They shared their last quarterly results just yesterday on October 19th, and they did have mixed results, coming in with an earnings beat and a slight revenue miss. For their Q3 revenue of $5.94 billion just missed expectations by $40 million, while earnings per share of $2.51 came out with a beat. The company did note that they faced many challenges in the quarter, including continued inflationary pressures and a drop in carloads. But they did note that operationally they gained momentum through the quarter and that through their day-to-day actions they'll continue to make improvements as they exit the year. Their stock currently has 23 analyst ratings, coming in as a moderate buy. That breaks down to 16 buy ratings and 7 holds, with an average price target of $246, which would be an upside of nearly 16%. If we just look at top analyst ratings, that does jump up to a strong buy with an upside of 17%. Down below, we can see a lot of the recent ratings coming in just these past couple of days. On the low end, we have a couple holds with upsides of 4.4% and a high-end rating from RBC, with an upside of nearly 34%. Next on our list today, we're taking a look at Procter Gamble. They trade under the ticker PG, currently priced at $149 per share. Over the past year, they've seen growth of about 19%, cooling off ever so slightly, down 2% in the last 3 months here. They do have a beta of 0.61% and score a 9 out of 10 on the TipRanks Smart Score. Procter & Gamble is a well-known consumer goods company with popular brands that you'll find in most homes across the country. Their brands include Tide, Dawn, Febreze, Vicks, Pepto-Bismol, Crest, Head & Shoulders, and Old Spice, to just name a few. And they have quite the track record when it comes to dividends. Procter & Gamble has been paying out their dividend for 67 consecutive years. And their current quarterly dividend comes in at 94 cents per share for a dividend yield of 2.54%. This is another company that just shared their recent quarterly report coming out on October 18th. They had both an earnings and revenue beat, plus the company saw their net sales grow year over year across all segments. Their Q1 revenue came in at $21.87 billion, beating analysts' expectations, and earnings per share of $1.83 came in 9 cents ahead of estimates. The company did maintain their fiscal year organic sales and earnings per share growth guidance range, saying that they delivered very strong results in the first quarter, putting us on track to deliver towards the higher end of our fiscal year guidance ranges for organic sales and core earnings per share growth. Several analysts have been weighing in on the stock following that report, and the Procter & Gamble stock currently has 20 analyst ratings, coming in as a moderate buy. With 13 buy ratings and 7 holds, the average price target for the stock is $165, which would be an upside potential of over 10%. Down below, we can see the most recent ratings, including 1 hold here, but it was upgraded from a sell, so that's moving in the right direction. Several hold ratings around that 3 to 4% upside, and some buys coming in the past few days from 8 to 17% upside. Third up is MasterCard. Their stock trades under the ticker MA, priced at $385 per share. They've experienced growth of 29% over this past year and are down just a couple percent in the last 3 months. They score a 9 out of 10 on the TipRanks Smart Score, and they do have a beta of 0.99%, and I was surprised it was that high, as the MasterCard stock is known to be quite recession resistant. MasterCard is one of the top 3 largest credit card issuers and payment processors. They have been an industry leader since they were founded back in 1966. The company has over 3,900 clients in more than 120 countries and handle more than 125 billion purchase transactions annually at more than 80 million merchant locations. MasterCard began paying their dividend back in 2010, and in the last 5 years, that dividend has doubled. With a current quarterly dividend of 57 cents per share, it's not the highest yield on the list today at 0.55%, but it is very well covered with a payout ratio of over 20%, and like I said, it has been growing pretty steadily. Their next quarterly report will be coming out next week on October 26th, and this follows both an earnings and revenue beat they had back in July. For their third quarter, analysts will be looking for earnings per share of $3.21, a notable increase over last year's. And in their second quarter, they reported earnings per share of $2.89, coming out with an earnings beat and revenue of $6.28 billion. That revenue increased 14% year over year. Management noted their positive momentum continued that past quarter, delivering strong revenue and earnings growth. Cross-border travel volume showed strong growth again, reaching 154% of pre-pandemic levels. The MasterCard stock is currently rated a strong buy with 22 analyst ratings. With 20 buy ratings and 2 holds, the average price target comes in at $458 for an average upside potential of over 19%. Down below, we can see a lot of recent ratings coming in just the past few weeks. On the low end, we have a hold with an upside of 10% and many others ranging around those mid-teens to low 20s with a high-end price target of 28%. And fourth on our list today is Eli Lilly. Their stock trades under the ticker LLY and is currently priced at $584 per share. They have seen some great growth this past year, up nearly 74%, including 27% in the last 3 months. They have a beta of 0.52% and score a 9 out of 10 on the TipRanks Smart Score. Eli Lilly is a pharmaceutical giant, recently gaining even more popularity as the hype surrounding weight loss drugs grows. For more than 140 years, they have worked to develop and deliver trusted medicines and diagnostics. Back in 1922, they were the first firm to commercially produce insulin. Eli Lilly has been paying their dividends for well over a century, with their first dividend dating back to 1885. And their current quarterly dividend comes in at $1.13 per share for a dividend yield of 0.74%. Their Q3 earnings report will be coming out in a couple of weeks on November 2nd. In their second quarter, they reported earnings per share of $2.11, beating analysts' expectations, and revenue of $8.31 billion. That revenue increased 28%. The company said that Lilly's financial results were led by Mounjaro sales and a strong performance from growth products. That Mounjaro is their diabetes/weight loss drug. Ahead of this next earnings report, the Eli Lilly stock currently has 19 analyst ratings, coming in as a strong buy. With 18 buys and 1 hold, the average price target is $620, which would be an upside potential of just 6%. But if we look down below, we can see a bit more details. In the past month here, all of our price targets are a bit higher than that, ranging from 7.5% all the way up to 21%. Scrolling back, we do have some ratings that are a few months old, and we've already surpassed those price targets, so it's bringing down our average price target there a bit, but I'm sure we'll see plenty of those reiterated following this next report. So there we have 4 dividend stocks to help defend your portfolio. Let me know your favorite out of this bunch and others that you love in this category. I always appreciate hearing from you guys. Of course, keep in mind these videos are never a suggestion to buy or sell any specific stock, just providing some insight and entertainment, so please make sure you're always sticking to your own investment plan. Thank you guys so much for watching. I hope you have a great weekend, and I'll see you back here next time.